How's it going, everybody? Bill Mervin, AnnieMac Home Mortgage, here in our Newtown, Pennsylvania offices. Today's video blog topic is going to be using second mortgages as a strategy on a new home purchase. Before we begin, I want to draw your attention to a link on our blog down below. Just click on that link. Myself or someone on my team will reach out if you have any follow-up questions or just want to talk. So today's topic is going to be talking about using a second mortgage as a strategy for a purchase strategy, for buying a home. So we're not talking about second mortgages that people may have heard of where you get a line of credit against your home and you use it for home repairs or you use it to pay off other debt. That's kind of a totally different topic altogether, and that's not what we're going to discuss here. So what we're going to discuss here is a second mortgage or a piggyback mortgage. Why they call it a piggyback is it's a mortgage that you get at the same time with a first mortgage. And you might ask, well, why would we get two mortgages? Why wouldn't we just get one mortgage? Well, the answer is there could be two times in particular where you might want to get two mortgages. Two things that you run up against are both mortgage insurance, which we've actually covered on a previous blog, where if you don't put 20% down, or if you have a first mortgage that is more than 80% of the value of your home, you have to get mortgage insurance. And depending on a number of different factors, sometimes it can be expensive. The other reason for possibly getting a second mortgage or a piggyback mortgage is because of the loan limits. The majority of the country, with the exception of a few what we call high county areas where there's very high priced homes, many of them are in either New Jersey or California, I believe, but there's not too many around here. It's $417,000. So if you were to borrow over $417,000, it is what's called a jumbo mortgage. Oftentimes there is far more red tape, and oftentimes there will be a premium, there will be a higher interest rate that will come along with that. So a second mortgage can accomplish one of two things, or sometimes both. A second mortgage will allow you, so if somebody's buying a house for $600,000, well, a 20% down payment would be $480,000. That would be a jumbo mortgage. So one strategy we could use is we could get a first mortgage for $417,000, and we could get a second mortgage for the difference, $63,000. Therefore, avoiding a more cumbersome loan process for a jumbo mortgage, and still getting a very, very good and likely a better, what we call a blended interest rate, the average interest rate between the first mortgage and the second mortgage, oftentimes in a situation like that will actually be better than the standalone one mortgage of a jumbo mortgage. Another time is somebody might not want to put 20% down, but they don't want to pay mortgage insurance. They're just against paying mortgage insurance. So in that case, we could get a first mortgage for 80% or 75%. And again, the way that they calculate mortgage insurance is if it's over 80% on the first mortgage. So if the first mortgage is 75 or 80%, and then you get a second mortgage for either 10% or 15%, you can actually borrow 85, 90% of the value of the purchase and not have mortgage insurance. Now the second mortgage rate will typically be slightly higher, but oftentimes, not always, but oftentimes the effective interest rate, the blended rate between the first mortgage and the second mortgage is actually better than the first mortgage with the mortgage insurance. So there's all kinds of caveats, there's all kinds of scenarios where one might be better than the other. It might make sense to do a jumbo loan versus doing two mortgage, or it might make sense to pay the mortgage insurance versus doing two mortgages. But as I've mentioned many, many times in our video blog, this is really why you want to partner with a professional who can analyze all these different options as it relates to your particular situation and kind of give not only some recommendations, but give the reasoning behind it so that you can really be certain that you are structuring your loan in a way that makes the most sense for you. It is not one size fits all. Many people think that, just give me your best rate, 20% down. There's much, much more to it. And this is something that we're seeing more and more of in the marketplace, second mortgages, and it's a great topic. So if you guys have any questions about this, more specific questions, please reach out to myself or someone on my team, and we'll be happy to discuss it further.